Thanks, Mark, and good morning and welcome, everyone. Today, we're going to cover off on three key insights in global equities. First of all, what we're seeing is that we're operating in a very concentrated market today, on one hand. Secondly, within that, valuation dispersion is really, really wide. And we do think there are lots of different cyclical and structural opportunities available to investors. So setting the scene, we have Joe versus Jerome. And in this period of fiscal activism, the central banker has a really tough job. At the end of the day, we've had one of these very tough tightening cycle. We know those tightening monetary policy acts with a lag. And that we can see it coming through the leading indicators. But at the same token, in this environment of fiscal activism, we have the Treasury, or we have the politicians expanding the fiscal deficit. So we have a really tight monetary environment, but a loose fiscal environment. And that's why inflation is staying sticky. And we think that environment is here to stay. So there'll be a lot of debate, a lot of discussion around, are rates going to be higher for longer, or is inflation going to come in lower than expected? I think what matters more is what do the next 10 years look like? And we think the next 10 years could look a lot like the 70s and early 80s, where the central bank and the Treasury are working against each other. So you've got a lot of policy volatility. That means you've got a lot of volatility in nominal GDP growth. You'll go from periods of high growth, high inflation, to low growth and in deflation, and back again on a fairly regular basis. Now, what happens to the market multiple in that environment? So when you look at the PE in the 70s, it averaged around 11 times. Now, that wasn't just because the discount rate was higher, because you had inflation and you had high interest rates. It was because of this volatility. It derated equities. Now today, the CAPE S&P multiple is 30 times. So the takeaway here is that US equities are offering really, a very narrow margin of error based on valuations today versus the regime that we think we've shifted into. Okay. Let's talk factors. What you want to look at on this chart is the yellow line, which many investors think about as the value factor. We prefer to refer to it as valuation dispersion, because we all know value and growth, or multiple and growth, are joined at the hip. But the yellow line is tracking the multiple you're paying for let's call it the lowest stocks in the market by quintile versus the highest. And you can see it's been trending down. So there's a lot of valuation dispersion in the market today. But if you want to own quality or growth, it's actually more expensive than it normally is. Now, we all know you should pay a higher multiple for those characteristics, but you're paying a very high multiple today. So you should think twice. You need to think about whether it is actually going to be durable growth and durable quality. Now, the other observation is this market cap concentration. It's crazy. Now, we go through these periods, and they don't tend to last. So in 1990, the market cap of the world was concentrated in Japanese equities. In 2000, it was concentrated in US tech stocks that were on a really high multiple. And today it's concentrated in the Magnificent Seven. Now, the Magnificent Seven, they're on punchy multiples. The average is, let's call it 36 times. But we know within that average, there's also a wide dispersion. You've got Tesla on a really high multiple, and then you've got, say, Meta or an Alphabet on much lower multiples. So a lot of dispersion even in the Magnificent Seven. But what you're actually seeing is a concentration of profit in the economy in a small number of companies. Now, everything else is on a lower multiple, and the more you move away from the US, the lower that multiple goes. So arguably, there's many sectors and many regions that are already pricing in a relatively hard landing. Now, the leading indicators around the world are telling you that 18 months after we started to tighten monetary policy, we are starting to see a proper slowdown. Now, we don't think that's priced in to, you've got to think about the Magnificent Seven. Why have they gone up? Why have they re-rated? In a tougher economic environment, the consumer-facing businesses like Apple, are they going to accelerate their revenue growth? I think that's really difficult given the maturity of their business. Is Alphabet, is Meta going to sell more digital ads in a recession than it is today? Is Tesla going to be able to sell more cars in a recession than it is today? Because you have to be very certain when you're paying that multiple that they can. And we would argue that that will be tougher. Now, you also have companies in that group that are arguably more defensive. Microsoft, it's got a great business, and AI is actually giving it more pricing power. So let's think about it. Are these past winners, is it rational to play defense in some of these companies that are maturing, that are becoming more economically sensitive? Okay, let's do a history lesson. I'll start by posing a question. In 2010, which of the 10 largest companies in the world, how many of the top 10 in 2010 are still in the top 10 today? And I'll answer that question, but I'll start with who was number one in the 1980s. It was IBM. So IBM effectively invented the PC. Now, IBM was famously dependent on two other companies, Intel for chips and Microsoft for the operating system. And it saw those two companies as suppliers, as just crappy supply companies, and they had they had what mattered, which was the hardware. Okay, let's go to 1990. Now, the biggest company in the world was NTT. Very boring company. It's the Japanese equivalent of Telstra. That's a long story, how that became the largest company in the world. Not enough time today. 2000. So all of a sudden, IBM has been disrupted by its two suppliers. Microsoft and Intel have taken all of that profit pool in personal compute. They've created what was known or became known as the Wintel monopoly. Then we had, coming out of the global financial crisis, China had a massive stimulus to stabilize the global economy, and it was companies that were exposed to China that became the largest companies in the world, PetroChina. Today, we all know Apple. So Apple brought the desktop computing power to our fingertips on a mobile device. So what is the point of this story? Historical lesson in history. The top 10 are constantly turning over, and they're turning over because of the competitive dynamic in the market. And really at Antipodes, what we're doing is we're navigating structural and cyclical change to the benefit of our investors. We want to avoid the cyclicals that become value traps. We want to avoid the growth stocks that end up being growth traps as they mature, and also take advantage of socio and macroeconomic change. So in our portfolio, we have 4 pillars. Our cyclicals, which are, let's call it lower growth companies, but nonetheless, we're buying them at multiples where they're attractive investments. We have our investment trends, which are companies that are transitioning to a more structural growth, and what we describe a tangible super cycle in investment. And then we have our defensive pillar or secular growth pillar, companies that are benefiting from structural growth but are still mispriced relative to that growth. And in our long-short fund, we have single stock shorts and tail risk hedges that are mispriced. So let's break out a few, starting with the cyclical opportunity. Today, when we look at China, it's very reminiscent for me anyway of investing in Japan in around 2011. It was very hard to find anyone who could have a positive case for the market, but valuations were at record lows, and there was lots of opportunities in really high quality companies. So for example, Alibaba today, and its equivalents like Baidu, you can think about these companies as being the Chinese versions of the Magnificent Seven. Now, instead of being on 36 times, they're on 10 to 12 times. They are very strong businesses. They're hard to break. They are run for shareholders, and they are priced for an extraordinarily high level of geopolitical risk and a very, very bad economic outcome. There's a significant margin of safety, and we think there is opportunities in these companies, and your downside is protected by the underlying business resilience. In our second example, some structural transition stories in the tangible onshoring, decarbonisation. Total is an oil company, but it is an oil company that has been biasing its investments towards natural gas as a transition fuel, hydrogen, as well as renewables. More than half of its investment is going into those areas. And if you're worried about downside or cyclical downside in oil, just keep in mind that we've been underinvesting on the supply side. So even in a tough, hard landing scenario, we haven't had the supply response to higher prices that we've had in the past. So you're on about a 15% free cash flow yield, so there's a lot of value in Total. And then our third sort of area of structural change, AI adoption. We see this as a very long-term trend. There are companies that, the companies that we think are in the best position to benefit from AI adoption will tend to be the ones who can monetize it with their business customers. I think it will be hard to make money out of selling AI services to consumers, but I think where there's a big productivity gain, companies like Microsoft with their Copilot will simply upsell it within their software. And we don't think it's priced in, that opportunity is yet priced into companies like Oracle, Microsoft, SAP. So in the 12 months to the end of July, our global long fund outperformed the market by 6%, and that was in an environment where China, our overweight to China, really didn't contribute. Our overweight to Europe did very well because 12 months ago, investors were very, very bearish on Europe because of the energy crisis. And you're getting a once-in-a-lifetime opportunity to buy some of the best companies in Europe at incredibly cheap prices. We think you're getting that similar opportunity in China today. Both our strategies have, in terms of their performance record, have also had very good, let's call it protection in down markets, where the global long-short fund has protected investors, has only been exposed to 45% of the downside. So the bottom line is that we observe a massive amount of concentration in the market. That tends to unwind. Valuation dispersion is very high, i.e. value as a factor is very cheap, and that we think that leads to opportunities. And we think investors should avoid paying yesterday's prices to solve for tomorrow's uncertainty in terms of crowding in to some of the Magnificent Seven as a defensive move. You need to be very wary of the potential for economic sensitivity in some of those names. I'll wrap it up there. Thanks for the opportunity to present.
Thanks, Jacob, and it's great to have a